Think you're ready to conquer the stock market? Not so fast. These 10 mistakes could drain your portfolio before you even get started. From falling for hot tips to letting your emotions rule your decisions, these pitfalls can sabotage your financial future. Hit that subscribe button, and let's jump straight into the first mistake you need to avoid. Alright, let's be real. We've all been tempted by those so-called insider stock tips. But acting on rumors and hearsay instead of solid research, that's a one-way ticket to losing your hard-earned money. If this insider information was so reliable, wouldn't everyone be cashing in? These tips often lack context or are based on outdated information. Instead of blindly following the herd, focus on building a solid foundation of knowledge. Learn how to read financial statements, analyze market trends, and understand a company's true value. So ditch the rumors, do your homework, and invest with confidence. Investing without a clear goal is like setting sail without a destination. You might end up somewhere, but it probably won't be where you want to be. Before you even think about buying your first stock, you need to define your why. What are you hoping to achieve with your investments? Are you saving for a comfortable retirement? Maybe you're dreaming of early financial freedom or funding your child's education. Having a clear objective helps you stay focused and tailor your portfolio to match your specific needs and timeline. For instance, if you're investing for retirement decades down the line, you can afford to take on more risk with growth-oriented investments. Remember, your investment strategy should be as unique as your goals. Let's face it, investing in the stock market always involves some level of risk. But taking on more risk than you can handle emotionally or financially is a recipe for disaster. Panic selling when the market dips? That's a classic sign of ignoring your risk tolerance. If you're prone to anxiety or have a shorter time horizon, lean towards more conservative investments like bonds or index funds. On the other hand, if you're comfortable with higher volatility and have a longer-term outlook, consider allocating a portion of your portfolio to growth stocks or even real estate. The key is to find the sweet spot that aligns with your individual circumstances and helps you stay invested for the long haul. Ever heard the saying, "Don't put all your eggs in one basket"? Well, in the world of investing, diversification is your safety net. Putting all your money into just one stock, no matter how promising it seems, is incredibly risky. That's why it's crucial to spread your investments across different asset classes, sectors, and geographical regions. This approach helps mitigate risk by ensuring that if one area of your portfolio is performing poorly, others can potentially offset those losses. A well-diversified portfolio might include a mix of stocks, bonds, real estate, commodities, and even alternative investments like cryptocurrency. It's about managing risk and positioning yourself for long-term success, regardless of what the market throws your way. Trying to time the market, buying low and selling high, might sound tempting, but let me tell you, it's a fool's errand. Even seasoned financial experts with years of experience struggle to consistently predict market movements. Instead of trying to outsmart the market, focus on what you can control, your investment strategy. Adopt a long-term perspective, invest consistently over time, and ride out the inevitable market fluctuations. Remember, time in the market is often more important than timing the market. By staying disciplined and focused on your long-term goals, you're more likely to achieve sustainable returns without the stress of trying to predict the unpredictable. When it comes to investing, your emotions can be your worst enemy. Fear and greed are powerful forces that can cloud your judgment and lead to costly mistakes. Panic selling when the market dips or chasing after the latest hot stock are prime examples of emotional trading. To avoid falling prey to emotional trading, it's crucial to have a solid investment plan and stick to it, regardless of market swings. This means having clear investment goals, a diversified portfolio aligned with your risk tolerance, and a long-term perspective. Making rational, informed decisions based on logic, not emotions, is key to achieving long-term success in the market. You might be surprised to learn that even small fees can eat into your investment returns over time. Whether it's expense ratios on mutual funds, trading commissions, or account maintenance fees, these costs add up and diminish your overall profits. Similarly, taxes can take a significant bite out of your investment gains if you're not careful. Opt for low-cost index funds and ETFs whenever possible, as these typically have lower expense ratios compared to actively managed funds. Consider tax-advantaged accounts like 401, KKs and IRAs to shelter your investments from taxes and potentially reduce your tax burden. By being fee-conscious and tax-efficient, you can maximize your investment returns and reach your financial goals faster. We've all been there holding on to a losing stock for too long, hoping it will magically rebound. But the truth is, hope isn't a viable investment strategy. Sometimes the best thing you can do for your portfolio is to cut your losses and move on. Holding on to losing stocks for emotional reasons like fear of regret or the sunk cost fallacy can prevent you from investing in potentially more profitable opportunities. Before you hit the sell button, reassess the reasons why you invested in the stock in the first place. Acknowledging a mistake and moving on is part of the learning process of becoming a successful investor. In the world of investing, sometimes less is more. Overtrading or buying and selling stocks too frequently can be detrimental to your portfolio's health. Every time you trade, you incur transaction costs like commissions and fees, which can eat into your profits. Instead of constantly trying to beat the market, focus on building a well-diversified portfolio aligned with your long-term goals. Invest consistently over time, reinvest your dividends, and let the power of compounding work its magic. By being patient, disciplined, and avoiding the urge to overtrade, you're more likely to achieve sustainable long-term returns. The world of finance is constantly evolving. New technologies emerge, market trends shift, and economic landscapes change. That's why it's crucial to approach investing with a lifelong learning mindset. Never stop seeking knowledge, expanding your understanding of financial concepts, and staying informed about market developments. Read books, listen to podcasts, attend webinars, and follow reputable financial news sources. By embracing a growth mindset and committing to ongoing education, you'll be well-positioned to achieve your financial aspirations and secure your financial future. So there you have it, the 10 costly stock market mistakes to avoid. By understanding these pitfalls and implementing the solutions we've discussed, you'll be well on your way to building a solid financial foundation. Don't forget to hit like, subscribe, and turn on notifications so you never miss a tip that could transform your portfolio. Keep learning, stay informed, and never stop striving for financial success. See you next time.